Hi guys, this is Chich here back again with another episode from Chicharito. Right, I've talked about Hup Seng earlier, right? Because they're like the T-Rex of the stock market, quite this ancient little dinosaur right in the market, and we are confident of their financial performances. We're confident that their biscuits, their beverages, their distributed products can actually last through like a very long cycle, right? But I think is these are all like, how do I put it, like more like logical assumption, right, based on what we see in terms of like projections from a market analyst and what we see from like historical performances. So I was thinking, why don't we do a stress test to exactly see, how a housing actually fare in bad economic conditions, and like to see how long they can last with the current cash flow they have. Hence, I'm actually doing today like an extinction test, get it? Because since they are a T-Rex, so let's see whether they can actually be extinct to that certain extent. And yes, to those wondering, I actually got a haircut. No, I didn't do it illegally. I actually bought my own razor and cut it. Thanks to my girlfriend as well. But yeah, without further ado, let's see, what are we gonna do today for the stress test or extinction test. Let's roll over and see. No, before I actually forget, right? Before we move on to the stress test, I have to point out that I've actually gotten the inspiration to do this video is because that I've actually chanced upon this website here. It's actually learn.moneywise.smart.com. So actually, it belongs to two good investor friends of mine, which is actually Rupam Deb as well as Fan Liang Chia. So they're actually both the founders of Money Wise Smart. So I'm in their Facebook investment group. So they've actually introduced this content here. So they've actually had two contents for free, which is Insperity as well as China Maple Leaf, not actually S4, sorry, China Maple Leaf, Bangkok ZK, as well as Upwork. I'll link this in the description below. But the point here to make is that I actually went through some of the materials. They've actually done some stress tests itself on their companies to see whether they can last long enough throughout very very bad economic conditions. So I'd just like to credit this method of doing the stress test to both of them, and before we move on to the important parts on how I do it for Hup Seng. Alrighty, I think everyone's getting feisty, like, oh, where's the calculation and all, right? So I present to you the sheet of stress for Hup Seng Industries Berhad. So just to give you a rough context on what we'll be going through today, there are three parts, it's actually not too complicated. We have question one, which is, what are the previous economic downturn effects on Hup Seng? So when I say previous, I refer to two noticeable time frames back then. So you got the dot-com bubble crisis back from 2000 to 2002, around that range, as well as the global financial, also known as the subprime crisis, between 2008 and 2010. So these two are like the two key events that actually saw the stock market actually took quite a beating. That is part one. Part two, we'll talk about how Hup Seng will fare in this COVID-19 situation, which with some parameters that we will set, and we'll talk more about this later on. And the last part, of course, will be on the verdict or the conclusion on whether we think Hup Seng will be a good pick, or dang it, it's already there. Never mind, just pretend you didn't see that. But anyhow, let's roll on to question one, and what kind of data we're analyzing here. Okay, for question one, let's go through the two economic downturn past histories that Hup Seng has gone through. So for the 2000 to 2002 dot-com bubble crisis, there is no info on this because if you were to do a rough Google on Hup Seng share price, you will find that Hup Seng was actually just listed in May 2006, which means it didn't have the chance to experience this. However, logically, right, seeing how it's like the dot-com bubble crisis, so it's to do with the companies which are in the online space, So seeing how Hup Seng probably back then, that was like in the 2000s, it's selling biscuit. It's not heavily related to e-businesses, and even with e-commerce, I believe it wasn't that mature back then. So impact can be presumed to be small. Moving on to 2008-2010, now for this one, yes, we do have concrete data to actually see what actually happened to Hup Seng throughout the 3-year period. So for this, I actually took 4 indicators which I believe will be sufficient to actually give us a gauge, in terms of how Hup Seng actually performed. throughout the very bad times, that everyone usually talk about. If you were to ask your parents, any teachers or people who are just who lived during those times, they would tell you, those times were bad. The recession, people wouldn't spend too much. But as you can see, the gross profit margin, which is actually the gross profit over revenue, so how much profit is a portion of the revenue, is actually rather increasing from 2008 to 2009. So actually, if I remember this correctly, the onset of the crisis was I think around was the end of 2008, I believe, and then it was 27% of gross profit margin. But turns out at 2009 and 2010, which is the parts where it started to recover, you can see the margins of Hup Seng actually pushing up quite a lot. And even during the crisis moment itself, GPM is actually rather reasonable. I mean, for me personally, myself, like above 20% of gross profit margin is actually considered okay, but I'm not too sure about you guys. And for the net profit margin, which is the profit before tax, over revenue, this was actually 7.29% as expected, because probably Hup Seng actually had had a lot of costs to actually be incurred, probably in terms of administrative and other things that we're not too sure of. Actually, didn't go through annual report, but I just rather extracted the figures. But what we can see here is that even though it was quite low here in 2009, 2010, it actually went up to 12, and then before going down to 10.65%. So that also, to me itself, is also a rather comfortable range, right, around the 10% net profit margin. For the return on equity, so this is the profit before tax out of the total equity they have. So ROE is usually to show how efficient the company is generating the profits out of the total equity that they have. So in 2008, it was 13.39, and generally for me, ROE of 15% is actually quite comfortable. So as you can see, even after the onset of the GFC global financial crisis, it actually rose to 20.10%. That's actually very high, although it did drop after that, once again 16.2. But I believe up to now, I think the last we checked in my previous video, I think the ROE was around 20+%. So I would say that Hup Seng is actually doing some work there to actually be efficient in their manufacturing, their administrative parts, as well as their their distribution as well, and marketing. Last but not least, we'll be looking at the free cash flow. So this is basically how much cash they have left, cash balance at the end of the financial year, after they've worked out, things to do with working capital, the cash which they use for investment, for financial activities, as well as for their operations. So as can be seen here, they actually had a decent free cash flow of 21.2 million ringgit. It actually doubled to 42.2 in 2009, and after that the growth kind of slowed down, but it still saw some growth there. So as you can see, the trend basically is a increasing gross profit margin and increasing net profit margin, but rather a slow one. ROE is increased and decreased, so it's a mix of that, and free cash flow is constantly increasing. So I think, rationally speaking, based on the data we have here, we can definitely say that this business of selling biscuits is really economic proof, I suppose. But I guess in bad times where people would want to conserve on their spending and buy cheap stuff, then I guess that's why the margins are sustained here for them. And ROE wise, I'm actually not too surprised, because Hup Seng, all this while, they've always been efficient in actually handling their processes. Even with the other video where we discussed, they bought ovens, new ovens from Italy, I believe, to actually reduce their operational wastage, as well as to improve the efficiency to around a 90% range, if my memory serves me right. As well as I look at the cash flow, which is actually growing, and they are able to pay out dividends with this cash flow without actually incurring too much burden on themselves. I think I forgot to mention about that here. But what I can say is that over the past 5 to 10 years, they don't have any debt. But back then, between 2000 and 2010, I'm not sure if they did have debt or not. But I do know that I've talked to some people and they said Hup Seng actually had bad experiences with debt, and hence, after that bad experience, they actually, decided that, probably incurring debt is not their thing, and they will not be, delving into leveraging all those sort of things. So yeah, that's my take on question one, where, the metrics are all okay, and hence, it's looking good so far, I guess, but we would still need to do like a stress test, because this here will be more like a historical, like in the past, but the next part will be more sort of like how will they do in the future. We'll be doing a prediction. It's not totally foolproof, but it'll give us a good or rough idea, I would say. That was the part on the past of Hup Seng in terms of their financials. So now that we have known the past, let's go to the current situation which they're facing, which is to do with the current COVID-19, as well as post COVID-19, which is during the recovery period. So two questions here, based on what I've actually gone through in Rupam's website in terms of his simulation. So question one is trying to tell us what we need to figure out in terms of the logic, the rationality, in terms of whether Hup Seng's business is going to fall badly. And falling badly means in terms of its revenues, its gross profits, what is the most likely figure that will fall, in terms of percentage. In Rupam's side, he actually went with 60%, but actually Hup Seng wouldn't fall that much, based on what I thought out. But we'll go through that in a while more. But let's just say for now, it's 60%. We'll go with this figure. Not saying how it's more than half. It's also considered stringent in a way. So what are the chances Hup Seng's revenue will fall by 60%? For me, I feel it is illogical based on the common sense, or common knowledge rather, that Hup Seng does biscuits and beverages. So imagine, in the COVID-19, during this movement control order or circuit breaker, people will still need to buy F&B, right? Food and beverages. Imagine like a day, without having anything to eat or drink, right? I mean, the common folk, would, definitely want to go to stores to stock up, on these things, and some will be, having the fear that, there will be like food shortage and thus, stock up even more. And also seeing how Hup Seng is a household brand, and they are actually, sometimes cheaper than their competitors, or rather, priced competitively. If you actually were to Google at Lazada or Shopee, sorry, I don't have it here, you will find that they actually are rather affordable to the masses out there, and during bad times, people will actually buy them more. If you think about it, that's logical, right? Also, like I said earlier, they have Lazada and Shopee. Hence, in a way, they got distributors. I believe the distributors are not Lazada or Shopee, but rather they sell to middleman people, and these middleman people actually sell on Lazada or Shopee based on what I observed. And not to forget as well, they actually have their goods all stocked up, in all those big super hypermarkets like Giant, Tesco, Aeon, and places like these. And last point to make here is that even during COVID-19 itself, right, which is the latest 2020 quarter one report, which you can find, on our websites like KIC Screen or Malaysia Stockbase, Hup Seng actually showed very good promise in sustaining only small financial pitfalls or losses. Let's go through this, on what I mean on small financial pitfalls. So for just to give a note, this table here is from Malaysia Stockbase, and these two are actually from Hup Seng's actual quarterly report, which you can actually obtain from the website or even from Malaysia Stockbase itself. Without further ado, let's zoom into this here. So if you were to see, this is Hup Seng, its code. This is the period of the report, which is quarter one 2020. So what they're doing here is actually comparing individual periods between 2020 and 2019. So what this means is that they're comparing the 3-month period from January to March for 2020, as well as for the same period of January to March in 2019. So what's the difference? Oh, so before we go into the difference, why they usually do this is because there might be other seasonal factors affecting the performance of a company. So perhaps it could be like Chinese New Year, like festivals. It could be like school holidays or things like that, affecting families' purchases at certain periods of time. If you think about it, right, like for certain food, like mooncakes, the kueh raya, things like that. So that's why sometimes they do the comparison for the same period, but different years. So if you were to compare the same period in these two different years, you notice that the revenue actually increased, even with COVID-19. So actually, they're actually making more sales, during this time of turmoil. But the bad thing is that the profits are actually dropping. Profit actually dropped by 8%, so it's profit before the income tax. Net profit after considering taxes and other things dropped by 4%. And the EPS, which is the earnings per share, also dropped by 4% due to the drop in profit. So these two are usually the same based on the formula. Dividends are not declared, obviously, and net assets per share drop as well. But for my point of view, I usually just look at the revenue as well as the profits. Whereas for EPS, it's the same thing as net profit, since EPS is earnings per share. So it's basically your net profit divided by how many shares are actually listed on the market. So let's move on to these two comments here on why their net profit actually fell, to give us a greater light in terms of what is actually happening to Hup Seng. So let's look at the explanations offered here. Let's move on to the first one, where it's actually to do with the explanation on Hup Seng's comparison between the two different periods. Two same periods of January to March, but for different years. Okay. So what it says is that the group's revenue for current quarter ended 31st March has increased by 7% as observed here, correct? This is due to why? This is actually due to domestic sales growing by 6%. So as you can see, even with COVID-19, Malaysia's sales are actually increasing for them. Export market sales actually saw an increase as well, and that's double of domestic sales figures. Impressive, right? And this is mainly from Singapore, Myanmar, and Mauritius. Mauritius, interesting. Didn't know that. And for the profit before tax, there was a drop of 8%. Once again, it tallies back to what we obtained from Malaysia stock base. And their explanation here is that poorer margins in certain segments, they didn't mention which one, could be beverages or their distributed products, and higher input costs are the contributing factors to the fall in profit before tax. Now, I know they didn't mention input costs here, but I would think probably input costs would be to do, during the COVID-19 times, where you would have to disinfect probably your factories, implement hygienic solutions like the hand sanitizers, the distribution of masks, ensuring that maybe there are thermal scanners, things like that, right? Probably that affected Hup Seng in the short run. Probably we'll see the adjustments to this new norm, and this cost will be more manageable. So I would think net profit of a drop 4% doesn't really make me lose confidence as an investor in that. So yeah, that's about it for the the similar quarter-to-quarter analysis, but different years of 2019 and 2020, where we compared the periods of January to March. So I think there are a curious bunch of you out there that thinks, oh hey, how about if we compare the current quarter compared to the immediately preceding or immediately previous quarter. So what that means is comparing the quarter 1 2020 with quarter 4 2019, right? So how does that go about? So yeah, this one here is for those of you who are curious ones, dedicated to y'all. Yes, I know there's always going to be a bunch which is super curious. So anyhow, let's go through this explanation here by Hup Seng. So if we were to compare the period of period ending 31st March 2020 with the previous ending period, which is 31st December 2019, group's revenue actually decreased 8% from around 88 million to around 81 million. What else? The explanation here is that it's due to a drop in export sales due to seasonal factors. Now, they do not clarify here, but I'm presuming that there may be certain factors in terms of the lifestyle of the people, which are people in countries where they export to. So perhaps it could be to do with the wages or how the bonuses are distributed at. But I think generally maybe most companies actually give the bonuses close to end of the year, so people tend to spend more during that, and also it's more like a holiday period or an end of the year period where there's sales, offers and things like that, so people tend to spend more at that quarter 4 of 2019 compared to quarter 1 2020, where where they start afresh after all that major spending, right? And they're going to be conservative in the way they adapt their spending habits. So that's what I think about it. That's an assumption, but I think it's a reasonable one, I suppose. Apart from that, they also said that the major contributor to this reduction in sales is it comes from the Asian regions. It's actually a whopping big number reduction, which is 27% or 7.4 million. And domestic sales, on the other hand, actually grew by 1% or 0.5 million due to the introduction of modern channels, which I assume could be the e-commerce channels, but I'm not too sure on this. Profit before tax, or PBT, decreased by about 18% compared to around 16 million, so 16 million to around 13 million in the preceding quarter due to lower sales recorded, which was mentioned here, and higher input costs incurred during the current quarter. So yeah, that's some explanation from there, and I think it's the general reasons. I don't know, input cost is higher probably due to administrative, or any other things. Administrative, as mentioned earlier, could be due to the COVID-19 preparations and adoption in terms of the hygienic practices. That's the only thing I can think of so far. Do comment if you think there's other logical reasons why the drop is so big from previous quarter to the 2020 quarter. But I would say I'll prefer this one here, this comparison, since it's more of a apple comparison between the same period but different years. I guess I think seasonal roles actually play a huge role in terms of like buying biscuits, especially Hup Seng biscuits, where it's more of like a low to medium cost product instead of like a how do I put it, instead of like a luxury product, where it's not depending on seasons. So yeah, those are my thoughts about it. Do let me know what else you think could be affecting their sales as well as their costs. So in question one itself, we talked about the likelihood of Hup Seng actually losing 60% of its revenues, right, for COVID-19 period as well as post COVID-19. So based on the explanation in terms of the common sense as well as some data which we saw just now in their latest quarter report, where the revenue as well as profits actually are opposite in terms where the revenue increased but the profits are dropping. We can safely say they wouldn't lose 60%, not such a huge figure. But that's it. Let's go to the worst case and just to see what happens. And hence question 2 will be exploring more of what will happen if their revenues, or in this case gross profit, drops by 60%. So let's dive in and see what happens. Before we move on to the income statement analysis as well as the balance sheet analysis, right, I'm just going to put out an assumption out there that since we said earlier that the revenue would drop 60%, let's assume as well that the cost of revenue will drop by 60% as well, such that our gross profit will drop by 60% as well. So moving on to this income statement here, which I actually dug out from Morningstar. You can actually go to their website. They provide the latest 5-year data as as free data for you to actually peruse through. So in my case, the gross profit actually dropped by 60%. Hence, I just took 0.4 times that cell. I'm going to assume the worst case scenario, of course, operating expenses won't be maintained, it will be reduced, right, if you were the management of the company. But I want to assume that it is maintained as the one in the TTM. Oh, sorry, TTM, if for those of you that don't understand it, it means trailing 12 months. It means the latest 12 months based on their accounting data which they provided. So as you can see here, assume total OPEX, operating expenditure, remains the same and our gross profit falls. This will result in a predicted EBITDA. So EBITDA is the earnings, or basically the total operating profit or loss. Earnings before interest, before tax, before depreciation, before amortization. So as you can see here, we've got a loss instead of earnings of around 11 million. And if you were to look at the interest income expense, you can see that Hup Seng actually has a very healthy net interest of around 2.7 million, leading to a constant net interest income position. So it means that they are not owing a lot of interest as compared to what they're earning in terms of interest, which they're probably putting in FDs or some other kind of investment instruments. So this leads us, with this income, this leads us to a loss, which is a loss, pre-tax loss, of around negative 7.8 million. So what does all these figures tell us about, right? returning to the summary here. So with a gross profit drop of 60%, this means it will become around 42 million. And remember how you assume the OPEX operating expenditure is maintained, does not drop. This will remain at around 52.4 million. So we'll have a loss of 10.6 million per year. For Hup Seng. This is also accounted for with the interest income, which is greater interest expense, leading to a net interest income of around 2.7 million. Right? And we'll see why this info of this 10.6 million loss is important to our balance sheet consideration after this. Moving on to the balance sheet part, we'll be doing the same analysis as well as how we did it in the income statement part. For this, before we dive into the summary, let's go into the balance sheet. Just as before, this is also data from Morningstar, so it's data for end of 2019. So the yellow parts are parts which interest me. Maybe there are other parts that interest you, but to me, I would look at things that actually affect their cash flow, or in case if they face any trouble, what can they liquidate, right? So in terms of that, I actually highlighted cash or cash equivalents or short-term investments, which comes to around 85.5 million for Hup Seng at end of 2019. Their inventories or stock, their biscuit stocks which they keep, their warehouses, it's around 24.3 million. Their trade receivables, which is around 36.6 million. So trade receivable means that these are amounts which people owe them, as well as there are current prepayments, their deposits. So these are things which they've already have deposited. What else is there? There's also so the things before that were their assets, right? So now let's look at their liabilities. So for accounts payable, so basically amount of money which they owe to their their creditors, that will be around 72 million, quite high amount. Their current debt and capital lease obligations, I've checked, they don't actually take debt for their business operations, but this is just rather their lease. So for their, I think it was more of their factories, this is only around 238,000. And to prove this, I actually went to their latest annual report, ending 31st December 2019. As you can see, the amount tallies with it. And the total lease liabilities is just 379,157. And so this amount is paid at the end of 2019. So what is left, long term for the upcoming years, which is 2020 and after, is just 140,000. If you were to add up these two, you actually get back this 379,157, which tallies here as well. So, and then that's just the equity. So what we have to note here is that if we were to consider, remember how in the income statement we know that Hup Seng will lose 10 million every year, right? If they were to have a 60% gross profit drop and maintain their OPEX, their operating expenditure. So 10 million loss. How long can they last with around 85 million of cash left? So this cash is untouched, right? Okay. So as you can see, if I were to take this value and divide it by the value in the income statement earlier, I'll get around 8.1 years. So this means Hup Seng can actually sustain around 8 years, if they do not cut their operating costs and their gross profit drops by 60%. How good does that sound, right? They can actually survive so many years, even with the drop in profits, with the cost maintenance there, with hard times that you can actually go through this in such a long time. And also moving on to some ratios, which I actually did just for my own interest. So if we were to do the ratio of accounts receivable to payable, it's actually quite low at 0.51, but this doesn't worry me since they still have a lot of cash. And even if we were to include the inventories and deposits or prepayments included, the ratio becomes better to 0.86, but still not above the generally recommended of 1, where your amount of your liquid assets to your amount of liquid liabilities are actually around the same in that case. Basically, these are just for my interest, but I think what matters here most is how much the cash can actually last them. You want a company that has enough cash and actually not much debt. As seen earlier, they just have their lease only, which can actually last them a very long time with this current situation that they're in. So this brings us to the summary of that. As mentioned earlier, Hup Seng has only the debt of lease liability, which is really the factories, and as much as 63% of this lease is already cleared as of end 2019. So they actually don't have much to actually pay back, and we've seen earlier that they've paid, I think, was it around 200 something thousand, and it's only like probably around 100 plus thousand left to clear by end of 2020 or 2021 and so on. But let's say their cash is so much larger than that, a few hundred thousand amount. The cash is like 85 million. So we also saw that the account receivable to payable ratio is actually quite low, so they actually owe their creditors more money as compared to how much they're receiving from people who owe them money. But do take note that this is just a ratio between the accounts receivable and payable, but doesn't consider all of their current assets as well as current liabilities. As evaluated earlier in my earlier video on Hup Seng, they actually have a very comfortable current as well as not current, but cash ratio as well as current ratio. So these two are actually quite healthy, so we don't have to worry too much about that. And this is also just for info, where the ratio from 0.51 to 0.86, it becomes better if you were to include other assets into the calculation. So yeah, the main point to take note from these two calculations is that assuming there's no other cash crunches, as in cash difficulties from working capital as well as bad debt, I don't think they'll have bad debt due to their experiences with bad debt earlier on. They would have 85.5 million cash to actually tank all the losses that we calculated earlier. And remember, the losses are actually a worst case scenario. It won't be that much because they'll logically try to reduce their operational costs. But yeah, in worst case scenario, with the worst case simulation, they'll actually be able to sustain up to 8 years, even with the interest expense of 21.6k included as well. Oh, whoops, sorry guys, I believe it's actually 19.6k. Just to clarify, because over here, if you were to see, we actually considered the interest expense, which is around 19.6k. That was a typo there. But what this basically means is that we actually considered this servicing of interest that every year that they have to do, and as well as the fact that they're actually receiving interest income. So with this, counted into our calculation of the losses, they can actually last up to 8 years with the current cash they have. So yeah, hope that clarifies it. And we thus come to our conclusion. What is the verdict on Hup Seng's survivability throughout and post-COVID-19? It is a very big and green yes. Hup Seng is really able to weather the economic turbulence pretty well. Mainly due to super low debt, as we have seen, they only got the capital lease, they got super large cash position of 85.5 million, stable profit margins as we have seen in the past, as well as in my latest video, I believe their margins are still sustained around the 30+%, and the ROE is like around 20+% if I'm not mistaken. Growing free cash flow, or growing or rather stable free cash flow as well. And even with the 60% drop, we can see that, and as well as constant OPEX, they can survive for up to 8 years with their current free cash flow. So that is all in terms of the simulation that we are doing for today in terms of Hup Seng. I hope this had been a informational video for you. I'll be actually putting a link as well to this sheet that I've done. So we welcome any feedback in terms of any accounting errors which I may have made as well, accidentally, because I'm not an accounting graduate, so I'm bound to make mistakes as well. I'm still learning this. So appreciate if we can learn from each other as well. So yeah, I believe that is about it. If you think this video is actually informational to you, it's helped you learn something new today, do give it a like, share it with someone, subscribe, and click on the bell icon. Thanks again for watching. I'll see you next time, guys.